April 14, 2021, a federal prison. An 82-year-old inmate dies in his cell. His name was Bernie Madoff. 12 years earlier, he built the largest financial fraud in history, $65 billion, thousands of victims worldwide. For 17 years, no one stopped him, until his own sons turned him into the FBI. The judge sentenced him to 150 years. 2 years later, his eldest son took his own life. This is the documented story of a man who lied first to himself. Bernard Lawrence Madoff was born on April 29, 1938 in Queens, New York. He was the second of 3 children in a Jewish family that struggled financially throughout his childhood. His father, Ralph, worked as a plumber after failing in the brokerage business. The household lived modestly. Financial stress was constant in the Madoff home. Bernie was not an outstanding student academically, but there was something he had from an early age that would define his life: extreme social ease and charisma. He spoke confidently. He inspired trust in adults from his teenage years. According to his biographers, these traits became the foundation of everything he would later become. In 1956, Bernie graduated from Far Rockaway High School. There, he met Ruth Alpern, the woman who would become his wife. They were 17 years old when they fell in love. Bernie enrolled at Hofstra University to study political science. To pay tuition, he worked as a Long Beach lifeguard and installed garden sprinklers in suburban homes. In 1959, Bernie graduated and married Ruth that same year. He was 21. With $5,000 saved from summer jobs, he founded his own brokerage firm. He called it Bernard L. Madoff Investment Securities. The office was a single room in Lower Manhattan. Bernie was the entire company at the start. The firm operated as a market maker, buying and selling small stocks not listed on the New York Stock Exchange. Madoff profited from the difference between buy and sell prices. The business was legal and competitive, but Bernie understood something few peers grasped about regulatory gray areas. Market makers could effectively set their own prices on small transactions. For nearly 2 decades, Madoff was a small but legitimate operator. His firm grew slowly. His marriage with Ruth was stable. 2 sons were born, Mark in 1964, Andrew in 1966. By 1970, his firm had become one of the most active in the over-the-counter market. He moved millions of shares daily. He earned commissions that supported a comfortable suburban life. But Bernie wanted more. He began offering an additional service to special clients, managing their money personally with guaranteed stable returns no other Wall Street investor could match. The promise was specific: between 10 and 15% annual returns, regardless of how the broader market performed each year. In losing years, Madoff's clients would still earn. It was a mathematically impossible promise. No legitimate trading strategy can guarantee such consistent returns over decades. But his early clients began earning exactly what he had promised. Word spread through New York social circles. What had started as legitimate brokerage had quietly become something different, something that would later be defined as the largest Ponzi scheme in human history. By the 1980s, Bernie Madoff was no longer the small operator he had been. His brokerage firm had grown into one of the most respected on Wall Street, occupying multiple floors of the Lipstick Building. He became actively involved in market regulation. In 1990, he was named chairman of NASDAQ, the second largest stock exchange in the United States. The industry trusted him with institutional governance. This dual role was extraordinary. Madoff was simultaneously a regulator of the markets and one of the most active operators in them. The conflict of interest was structural, but no one questioned it. His public reputation became impeccable. He participated in regulatory committees. He gave talks at Harvard and Columbia. He donated millions to Jewish charities. He was a respected community leader. But Behind the public reputation, the private Ponzi scheme was growing. In the 1980s, according to trustee Irving Picard's investigation, Madoff was managing approximately $1 billion in client funds. By the 1990s, the figure had grown to $5 billion. By the year 2000, to $20 billion. The scheme expanded exponentially as his promised returns attracted more sophisticated investors. What did Madoff actually do with the money? Almost nothing. The SEC investigation found that he did not invest the funds in stocks at all. He kept the money in a single Chase Manhattan bank account. When investors requested withdrawals, Madoff paid them with money from new investors. This is the technical definition of a Ponzi scheme. But there was a critical difference with previous schemes in history. Madoff's investors were not naive individuals. They were the most sophisticated institutions in the world. Banks, hedge funds, family offices, university endowments, charitable foundations of every kind. The victim list included HSBC, Banco Santander, Royal Bank of Scotland, the Walter Knoll Family Fund, the Yeshiva University Endowment, and hundreds of Jewish charitable organizations worldwide. Madoff did not seek out these investors. They came to him. The exclusivity of being accepted as a Madoff client became itself a status symbol in elite New York financial circles. Madoff cultivated this exclusivity strategically. He frequently refused new investors. This refusal generated even more demand. The waiting list to invest with him became legendary among the wealthy. His personal lifestyle reflected enormous success. A penthouse on Manhattan's Upper East Side, a waterfront mansion in Montauk, a vacation home in Palm Beach, a 55-foot yacht named Bull. The most interesting aspect of his lifestyle was its relative restraint. Madoff did not flaunt his wealth or appear in society magazines. He cultivated an image of dignified seriousness instead. That restraint was, paradoxically, what made the scheme work. Flashy fraudsters get caught quickly. Madoff appeared to be exactly the opposite. A respectable family man dedicated to quiet, long-term investing. Inside the company, something disturbing was happening. The secret 17th floor where the false accounts were managed was completely isolated from the rest of the firm operations. Only a handful of trusted people worked there. They fabricated fictitious trading documents and managed the false records that the scheme required to function continuously over decades. By 2007, the funds Madoff claimed to be managing exceeded $65 billion. He had become the largest private money manager in the world. His image was completely consolidated. The peak of Madoff's empire occurred between 2005 and 2008. During those years, his fund attracted capital at unprecedented rates from every corner of the globe. The victim list included names like Steven Spielberg, Kevin Bacon, Larry King, Sandy Koufax, the Wilpon family, owners of the New York Mets, the P. Cower Foundation, the Elie Wiesel Foundation. But Madoff's greatest victims were institutional. Pension funds, charitable endowments, retirement accounts. Tens of thousands of ordinary families would lose their savings indirectly through these institutions. During those peak years, Madoff gave speeches at investment conferences. He participated in industry panels. He was interviewed by the Wall Street Journal and the New York Times as a market authority. He spoke publicly about the integrity of financial markets, about the importance of trust between operators and investors, about how the financial industry needed to maintain ethical standards. This is perhaps the most disturbing aspect of his case. When Madoff spoke publicly about ethics and trust, according to psychologists who studied him, he was not being cynical. He genuinely believed himself to be a defender of those values. The legitimate operation existed. He treated his employees well. He donated to charitable causes. From his perspective, he was respectable. That self-perception is what allowed him to continue indefinitely. The scheme had become inseparable from his identity. There was no internal moment of crisis where he could have stopped himself. But warning signs were appearing. Harry Markopolos, an independent financial analyst, had been studying Madoff's returns since 1999. The mathematical patterns were impossible to explain. Markopolos made multiple formal complaints to the SEC. But the SEC, in what would later be documented as institutional negligence, did not seriously investigate the most respected man on Wall Street. In September 2008, the global financial crisis exploded. Lehman Brothers collapsed. World stock markets crashed. The system that Madoff had exploited for decades suddenly broke. His investors, panicking, began requesting massive withdrawals. Banks needed liquidity. Family offices needed cash. Within weeks, withdrawal requests reached $7 billion. But Madoff did not have $7 billion. He had never actually had the money invested. The Chase Manhattan account contained only a fraction of what was now being demanded. For the first time in 17 years, the mathematics of the scheme broke. There were not enough new investors arriving to pay the old ones. The Ponzi mechanism had ceased to function. During the first week of December 2008, Madoff knew the end was coming. The withdrawal requests kept arriving. Within days, the entire scheme would collapse publicly. On the night of December 9, 2008, Madoff did something extraordinary. He invited his two sons, Mark and Andrew, to his Upper East Side penthouse. Ruth was there. He sat them down. According to the sons' subsequent sworn testimonies, Madoff told them everything that night. The fund was a Ponzi scheme. It had been won for decades. There was no money left. Mark was 44. Andrew was 42. Both worked in the legitimate brokerage operation on the lower floors. Neither had any idea of what their father had been doing on the 17th floor. Their reaction was shock, then devastating clarity. Then, after consulting with their wives and lawyers, the decision that would define them forever: report him to federal authorities immediately. On December 10, 2008, Mark and Andrew Madoff walked into FBI offices in Manhattan with their attorneys. They told agents that their father had confessed to running a multi-billion-dollar Ponzi scheme. The FBI moved quickly. On the morning of December 11, 2008, agents knocked on the door of Bernie Madoff's Upper East Side penthouse. He answered the door himself, still wearing his bathrobe. Agent Theodore Cacioppi asked Madoff if there was an innocent explanation for what his sons had reported. According to the official FBI report, Madoff said, "There is no innocent explanation." He was arrested at 8:30 in the morning. Agents escorted him out of his building in handcuffs. Reporters had already gathered outside. Photographs of that morning circulated around the world within hours. The collapse was immediate. The federal court froze all his assets. The Lipstick Building offices were sealed. The fictitious documents from the 17th floor were seized as evidence. In the days that followed, the scope of the fraud became public. $65 billion in claimed assets, $17.5 billion in actual stolen principal, thousands of victims across more than 40 countries. Bernie Madoff was released on a $10 million bond and confined to his penthouse under house arrest while awaiting trial. Ruth remained with him. His sons never contacted him again. On March 12, 2009, Bernie Madoff appeared in federal court in Manhattan. He pleaded guilty to 11 federal felony charges, including securities fraud, money laundering, and perjury. He waived his right to trial. He waived his right to a plea bargain. He accepted full responsibility for the entire scheme, knowing this guaranteed the maximum possible sentence. On June 29, 2009, Judge Denny Chin issued the sentence. The courtroom was filled with victims who had been allowed to give impact statements. Many wept openly during the proceedings. Judge Chin described Madoff's conduct as extraordinarily evil He imposed the maximum sentence allowed by law, 150 years in federal prison. Madoff was 71 years old. He was transferred to the Federal Correctional Institution in Butner, North Carolina. He would serve his sentence in the standard prison population, not in special protective custody. In the years that followed, Madoff gave multiple interviews from prison. The interviews offered an extraordinary window into his psychology and his enduring self-perception. According to psychologists who studied these interviews, Madoff focused intensely on harm caused to his family. He spoke less about institutional victims and more about his sons. He said repeatedly that he had not intended to harm anyone, that he had believed he could correct the scheme eventually, that the 2008 crisis had broken something he hoped to fix. On December 11, 2010, exactly 2 years after his father's arrest, Mark Madoff was found dead in his apartment in Manhattan. He had taken his own life. He was 46 years old. Mark's death devastated the family. Ruth Madoff, who had remained loyal to Bernie through the early scandal, finally cut off contact with him after Mark's death. On September 3, 2014, Andrew Madoff died of cancer. He was 48 years old. In an interview before his death, he spoke about his father with profound anger and inherited trauma. In April 2021, Madoff was diagnosed with terminal kidney disease. He requested compassionate release. The Bureau of Prisons reviewed his case. The request was denied. On April 14, 2021, Bernie Madoff died in his cell at Butner. He was 82 years old. He had served 12 years of his 150-year sentence. The trustee, Irving Picard, had recovered approximately $14 billion for victims. The Madoff case left history 3 concentrated lessons that connect with the central thesis of this channel. The first lesson is about institutions. The financial system itself enables certain types of fraud through institutional trust mechanisms. The most sophisticated investors became victims because they trusted the system itself, not Madoff individually. The second lesson is about self-perception. According to the psychologists who studied his case, self-perception can sustain itself across decades despite overwhelming evidence to the contrary. Madoff was not lying when he claimed not to feel like a criminal. His mind had constructed a parallel reality that he genuinely inhabited throughout 17 years of operation. The third lesson is the most profound. The most dangerous fraud is not the one we plan from the beginning. It is the one that begins with a small lie we tell ourselves expecting to correct it. Bernie Madoff's story is not about money. It is about how a single lie, told first to oneself, can grow until it consumes everything one loves. Because in the end, the absolute certainty that we can fix our own mistake is the same certainty that prevents us from ever stopping. If you choose to witness their stories, subscribe to Rise and Ruin. Next, we follow another empire from glory to dust.